Cost structure. Okay. So, in terms of cost structure, employee benefits, yeah, or employee salaries, they totaled 365 million in 2024, which is an increase of 33 million from the prior year, and it represents a 55.1% of total revenue. Yeah, it represents 55.1% of total revenue and 60% of total operational expenses. And this includes performance bonuses and social security costs too. Yeah, so a lot of our expenses, the majority of our expenses goes on salaries. Okay. In terms of operational expenses, yeah, at least the other ones, you've got amortization of intangible assets, which is 190 million, depreciation of 17 million, exceptional items of 48 million, other costs of 149 million, and then obviously you got your net finance costs of 61 million. And basically your amortization, if you subtract the employee salaries, yeah, that's 47% of your operational expenses is amortization of intangible assets. Right? And these intangible assets player are the players. Yeah. So you amortize the transfer of the player or the player value over the lifetime. You tend to do it over the lifetime of the contract, and that hits the INE, right? The depreciation would be of non-current assets. Yeah, so that would be like your stadium and stuff. And then your other costs, I've brought this down on the next slide. So that makes up 37% of operational expenses. And your exceptional items, that was to do with the sale, to be fair, this year or the last year, which totaled 48 million. Yeah, and that was the Glazers doing their strategic evaluating strategic options. A lot of it was around that. Yeah, you can find this in the annual report. This is part of the finance section. Okay, in terms of other costs, so this is a breakdown of the 149 million. So 20% would be external match day costs. You got 19%, which is sponsorship and commercial and broadcasting costs. 23% is property and utility costs, so they're the major ones. 17% is other operating expenses, like individually they're less than 10 million, so it's not that big. And then 11% legal progression and consultancy costs. Right? So you can see that we spend a lot on property and utility costs. Yeah, to run a stadium, it does cost a lot, in it, and to run Carrington and all the other facilities, they do cost. So Sir Jim would be looking at this. Yeah, Sir Jim would be looking at the operational expenses, the salaries, and the other costs, and seeing where he could optimize. Yeah, that's what he would be doing. Balance sheet position. Right. So you got total assets, yeah, of 1.3 billion. Yeah, that's a 2% increase on the prior year. Now, of that 1.3 billion or 1.34 billion, right? Actually, 1.35 billion if you want to round it properly. Yeah, 1.2 billion is non-current assets, so that's the majority of it. That's up 3.85% over the prior year. And that's made up of intangible assets of 838 million. And of those intangible assets, goodwill is 421 million. So this is basically the brand. That's 50%. So it's kind of like a half and half split, to be fair. And registrations is 409 million. Registrations is players. Yeah, players count as intangible assets or sit as intangible assets on your balance sheet. Then you got property, plant, and equipment, which would include like the stadium and Carrington as well. 256 million. That's up 1.12% over the past year. And then current assets is 177 million, which is down 8.49% over the prior year. Cash 74 million. That's down 3.25% on the past year. You got trade receivables, 37 million, up 18.71% over the past year. Okay. In terms of liabilities, the total liabilities was 1.2 billion. That's a decrease of 1.16% over the prior year. We still have borrowings of 547 million, down 10%, sorry, 10.87% over the last year. And of that 547 million, that's made up of senior secured notes of 335 million, the secured term loan, which is 177 million, and revolving facilities of 30 million. You also have the working capital position. So the current ratio was 0.36 and the quick ratio was 0.37. Now, the current ratio basically is the current assets divided by the current liabilities. And this basically measures short-term liquidity. It shows the ability of the company to pay short-term obligations. Right? Now, normally below 1 indicates potential liquidity issues. Okay, and it's a key indicator for creditors in a normal company. Yeah, and standard business. The quick ratio is more stricter, and it's basically current assets less inventory. Right now, we divided by current liabilities. Now we don't really have, or Manchester United doesn't really have that much inventory. Most of our assets are non-current assets. Yeah, they're not current assets. Okay, but the quick ratio is a stricter liquidity measure. It excludes less liquid assets, and it's more conservative, than the current ratio. And it's just a better short-term indicator if we're in serious, financial problems. Okay, and there's a working capital deficit this year. In terms of financial performance, total revenue was 662 million in 2024. Of that, the commercial side, we have 3 revenue streams. We have commercial, broadcasting, and match day. So commercial made up 303 million, which is 45.8% of total revenue. And that's split between sponsorship at 178 million and retail merchandising and licensing at 125 million. Then we've got broadcasting, which made up 33.5%. We had broadcasting, which is 222 million, which makes up 33.5% of total revenue. And that is broken down to domestic competitions at 162 million and European competitions at 54 million, plus other at 62 million. I'm not sure what the other is, to be fair, but it's between the two main ones, domestic competitions and European competitions. Yeah, you're looking at around 215 million, like that. And then match day, which is a third revenue stream, you had 137 million, which is 20.7% of total revenue. And like I said, Old Trafford is sold out majority of the time. Yeah, sold out majority of the time. That's 20.7% of total revenue. Now, looking at these profitability metrics, see they made an operating loss of 69 million, which is an increase from the 11.2 million loss they made in 2023. They had a net loss of 113 million, which again is an increase from the 28.7 million loss in 2023. Now, with that being said, the EBITDA is 185 million. Right? EBITDA stands for earnings before interest, tax, depreciation, and assets. Yeah, that's 185 million. And this is what, for a football club, investors, or let's say creditors, will look at. Okay, because you're basically adding back the amortization, you're adding back the depreciation, right? So your EBITDA shows operational performance before accounting adjustments. Okay, so your depreciation and your amortization mainly, right? That's 185 million. And it's an increase from the 175 million in 2023. So Manchester United do make money. Yeah, they make 185 million, when you exclude the amortization of players. However, free cash flow was 85.5 million. Minus 85.5 million. Yeah, that's a loss. Okay, which is an increase from the 44.4 million loss that they made in 2023. And Surgeon will be looking at this. Yeah, it's very important to investors. Okay, so let me explain what free cash flow is. Yeah, free cash flow represents the actual cash available to a company after accounting for capital expenditure and working capital needs. Okay, so it shows how much cash a business generates after spending the money required to main or expand its asset base. Yeah, so with a free cash flow of minus 85.5 million, Manchester United don't have money. Do you understand? And like I said, this is what Sir Jim will be looking at, yeah, or looking to optimize. Yeah, you want to have free cash flow, yeah, or you at least want it to break even. Yeah, to be negative is a real problem. It's an issue. Yeah, but for banks and for creditors, let's say, EBITDA is a key metric for football clubs, especially just because of the structure, how they're structured, and the amortization. When you remove that, obviously you see that Manchester United makes money. Yeah, they make 185 million. So just looking at the ratios, operating profit margin was minus 10.5% in 2024. Yeah, it's down from minus 1.7% in 2023, and in 2022 it was minus 15%. Okay, so this ain't good. Yeah, to any business, any other business, this would not be good. Right? The operating profit margin. So the operating profit margin basically shows profitability from core operations. It indicates operational efficiency. Yeah, and this excludes financing and tax impacts. Okay, and it's a key performance metric for most businesses. Yeah, for most businesses. We're dealing with a football club, so it's a bit different. For the net profit margin was minus 17.1% in 2024 or last year. Before that, in 2023, it was minus 4.4%. And before that, it was minus 19.8% in 2022. Yeah. And that shows the overall profitability after all costs. Yeah. So net profit is the bottom line performance measure and includes all business aspects. Okay. And it's a financial measure of efficiency. Right. So you can see that Manchester United are not efficient at all. They're not efficient at all. But the EBITDA margin, yeah, as I said, earnings before interest, tax, depreciation, and amortization was 28% in 2024, which is an increase from 2023 when it was 27%, and even 2022 when it was 17.9%. So based on that, Manchester United are doing well. They're not in trouble like that. Yeah. And like I said, EBITDA shows operational performance before accounting adjustments, right? It removes the impact of financing decisions. Okay. And it's also useful for comparing companies. So you can compare Manchester United with Arsenal or Juventus or Man City, another football club, right? Not many are on the stock exchange or listed companies. I'm sure Juventus is. If I had the time, I could probably compare the two, but it's not that serious. Yeah, it doesn't have to be that serious. This is just for fun. But yeah, so based on the EBITDA, it's increased year on year. Okay, so it's up year on year. Right, so that's positive for creditors and investors. Yeah, and it's key. It's a key metric for debt covenants as well. Manchester United's got a debt covenant that says that the EBITDA has to be more than 65 million. Yeah, in each period, each 12-month period. If it's not, they would break their covenants. They would break their debt covenants. Okay, so with a EBITDA of 185 million, it's more than double. Yeah, it's more than double the debt covenant. So they've got space, they've got room. Right. Now looking at the lender ratios, obviously we spoke about the current ratio and we spoke about the quick ratio, which are liquidity ratios. That's been stable across 2024 and 2023. In terms of leverage, the debt to equity was 3.77 in 2024 and it was 5.9 in 2023. Yeah. Debt to equity shows financial leverage, it indicates financial risk, and it's a capital structure measure, yeah, which is usually key for lenders. Right? The debt to total assets was 0.41, right, in 2024, and it was 0.47 in 2023. Okay, which shows an improvement. If it's lower, that's an improvement. Right? Debt to total assets is total debt divided by total assets, and the importance of it is that it shows the proportion of assets financed by debt. Okay, it's an alternative leverage measure, and it basically shows asset coverage of debt, right? And it's a risk indicator. Okay, so even though the debt to equity was high, yeah, the debt to total assets is 0.41. Okay, and as we were saying, Manchester United has been financed mostly by debt, yeah, through debt. However, our non-current assets, especially, cover the debt. Yeah, so if we ever had to sell up, yeah, Manchester United would be fine. Do you understand? So they're not in financial trouble like that. Yeah, let's just put it that way. And again, with interest coverage, in terms of interest coverage, banks look at EBITDA. So interest coverage is the EBITDA divided by the interest expense, right? In 2024, it was 2.9. In 2023, it was 3.9. And in 2022, it was 1.2. So 2022 was really a tough year. And that was the year that they really started to look at this strategic review, to be fair, or the Glazers. Yeah, this is when they said, okay, we need investment. Yeah, because a coverage of 1.2, you're teetering on the line of trouble, yeah, because you're not able to finance your costs. Yeah, you're not able to finance the interest costs, right? I was just checking to see if I had the EBITDA for 2022, but I don't. And then I could show you what that was, but I only have it for the prior year. Okay. Now, in terms of investor ratios, so this is what investors would look at. Return on equity, yeah, ROE was minus 78.1% in 2024. In 2023, it was minus 27.6%. Right? Return on equity is basically net profit divided by shareholders' equity. Okay. And it measures return to shareholders. Yeah, it shows efficiency of the equity use, and it's a key profitability metric, yeah, which is important for investors. Now, the return on assets, which is net profit divided by total assets, was minus 8.4% in 2024, and in 2023 it was minus 2.2%. So even from return on equity to return on assets, it's decreased. Yeah, there's been a negative trend year on year, right? And again, that measures asset efficiency. It shows management's effectiveness, and it's an overall performance indicator. Yeah, again, it's a key efficiency metric. Okay, so for our assets aren't generating enough return. Okay, earnings per share is defined as net profit divided by the number of shares. Right. So in 2024, it was 0.66 minus 0.66 per share. Yeah. So that shows profit per share, and it's a key investor metric, and it's the basis of valuations, right? And it's also a growth indicator. So at 0.66 per share, Manchester United wouldn't be a good investment based on their based on this annual report. Yeah, this for a normal company, this will signify trouble. Yeah, this would be very troubling, right? The PE ratio was minus 19.5 times. Right? Price earnings ratio, which is basically the share price divided by EPS. Okay, and this is another valuation metric. It shows market expectations. It's a useful comparison tool as well to compare companies, and it's an investment indicator. At minus 19.45%, from a traditional investor standpoint, it's not worth it. This club will not be worth investing in. Yeah. So negative profitability shows, sorry, negative profitability metrics show operational challenges. Low liquidity ratios indicate working capital pressure. Right? The high debt to equity shows significant leverage, which we know. The negative return shows poor financial performance, and this includes the ROA, return on assets. And the negative PE ratio indicates unprofitable periods, right? And I'm sure the previous year you had a negative PE ratio too, yeah. So it's not good. Yeah, it's not good at all. Yeah, so from a pure investment perspective, Manchester United stock would be unattractive because there's no income return. Yeah, there's no dividends being paid, okay, at the moment, right? There's no return on capital to shareholders, yeah, and there's just no income stream for investors, right? So there's normally two ways that investors typically make returns on stocks. Okay, so it's dividends, which is income return, and it's share price appreciation, which is just capital return. Right. So with Manchester United, there's no income return. Yeah, dividends aren't being paid. Right. There's no capital return. There's no capital growth. Right. The share price has been stagnant. Yeah, for the last since it's been on the stock market, it's been quite stagnant. To be fair, there's no capital appreciation. There's no wealth creation through price increases. Yeah, you can find better investment opportunities like Nvidia. Yeah, tech stocks. Those are growth stocks, right? Yeah. So Manchester United, from an investment perspective, pure investment perspective, wouldn't be attractive at all. Like I wouldn't invest in Manchester United, right? So if neither of these are happening, right, investors are getting no return on investment. They're potentially losing money to inflation, yeah, and they're missing opportunity costs on better investments, yeah. So that missed opportunity is a cost, right? So this wouldn't be a sound investment given the continuing operating losses, the negative free cash flow, the high levels of debt, and also the large capital requirements, yeah. Unless there is expectation of future dividend reinstatement. Now, as I said earlier, I think the restrictions lift in 2027. Yeah. Share price growth potential, a potential takeover premium. Yeah. Which is why, when the Qataris put in their bid, the share price shot up. Do you know like that? Because there was a potential takeover premium, right? Or there's a significant business turnaround. So the stock would be difficult to justify as a pure financial investment. And this explains why many football clubs, their shareholders are often like strategic investors. They're either fans with emotional investment, they're long-term holders looking for influence, or they're just brand or prestige buys. Yeah. So it's just individuals with money, yeah, or countries with money that want a brand to add to the collection. Do you know like that? So yeah, that's the financial performance of Manchester United.